Greetings, everyone. This is the June 2023 monthly update for the Argonaut Absolute Return Fund. During June, risk assets rallied quite hard on the back of strong economic data, particularly from the US labor market, and some general relief that the rebuilding of the Treasury General account following the debt ceiling being removed hasn't yet caused the liquidity crisis that some of us had been predicting. The fund lost over 4% during the month, and that was all due to losses on the short book. The long book made a positive return. And this was just a general cover bid in markets in general. And that's the nature of the beast when you're a long short fund, that just like you can get positive uncorrelated returns, you can also get negative uncorrelated returns. We think this market reaction was a slightly irrational glass half full response. The strong economic data means that the Federal Reserve will keep raising rates. The bull case for markets a month ago was that the Fed were done at 5.25%. Now they'll almost certainly raise rates in July and probably in September again. We saw the Bank of England also raise rates to 5% during the month, and the market now thinks that the Bank of England will have to go over 6% to tame inflation. And we think that's going to be a pretty big problem, not just for the economy, but for markets in general. The big questions is why economies have proven so resilient so far to rate hikes, because I think most of us would have thought 18 months ago when central banks started raising rates that the global economy would have already ground to a halt at 5% Fed funds rates, and it's still proving remarkably robust. And I think there are two reasons for this. First, just the sheer scale of the monetary and fiscal largesse during COVID, when essentially both in the UK and the US, central banks expanded their balance sheets by about 20% of GDP, and at the same time, governments ran big fiscal deficits around about the same amount. So this was just an extraordinary attempt, if you like, to bribe the electorate with their own money during COVID. Obviously, printing more money, spending more government money ends up being funded by the people in the economy themselves. And this caused a huge, if you like, balance sheet buffer where the amount of money in the economy grew a lot faster than nominal economic growth. And as a result, we got inflation because there was too much money relative to the size of the economy. The other thing, I think, which is causing the problem and meaning that central banks are actually having to hike more than what they would normally do, is that governments are still running extraordinary high fiscal deficits of 6 to 8%. And Truss and Kwarteng, during their brief period in government in the UK, were obviously criticised for running fiscal stimulus at the same time as the banks were trying to withdraw, central banks were trying to withdraw stimulus. They were trying to do it through tax cuts, which seemed bizarrely more controversial than just government spending people's money on unproductive capacity in the economy. So the fact that governments are running these big fiscal deficits mean that interest rates have to go higher to offset some of this fiscal stimulus. And it's pretty unhelpful, I would say, at this point of the cycle, when central banks are trying to slow the economy, that governments are running big fiscal deficits that are actually stimulating the economy. And I think one of the problems that we have in I think predicting that treasuries or gilt yields are a good or a one-way bet here is that it's not clear where the political acceptance that they need to balance the budgets is going to come from. Obviously, we have an election coming up in the UK and the US next year, and I would say it's unlikely that the parties are going to say they need to balance the budget. So we could have another big leg higher in gilt and treasury yields, which not only will eventually have a pretty big impact on the economy, but also I would argue will crowd out investments in all other assets. Essentially, if the risk-free rate is 6%, then people will wonder why they need to take extra risks to invest in assets other than those government bonds. So we've said all along that we think it's unlikely that inflation will return to 2% without a big recession. And I think, the confidence in that really comes from the lack of any historical examples when inflation has been over 5% and it's got back below 2% without a recession. It's also pretty impossible to find any examples where central banks have hiked by 500 basis points or more in 18 months without causing a recession. And we've got deeply negative money supply growth at the moment. So it feels a little bit in markets that we're investing at 5 minutes to midnight. And the fact that we haven't had a recession yet doesn't mean that we're not going to get one. In fact, it probably means it's more likely that we get one, because central banks will have to keep raising rates until we get the recession that they need to slow inflation. And it was Milton Friedman, the great US economist, who first coined the phrase that monetary policy works in long and variable lags. And I think all that we're waiting for is that those long and variable lags work themselves through the economy. And I think monetary policy is already restrictive, but I think central banks will feel the need to go into more restrictive territory because they simply can't be patient and wait for the recession to happen, because they know the longer that wages keep growing at 5 or 6%, that keeps being embedded in the economy. Now, people will criticize central bankers as being like, to use another Milton Friedman analogy, the fool in the shower who turns the shower on and it's cold, and that's because the pipes take a while to warm up, and then keeps increasing the temperature because he's not waiting for those pipes to warm up, and ends up scalding themselves. And so this fool in the shower analogy is probably now what is happening in terms of central banks over tightening. But I think there's a pretty good reason why they're doing that as well. Interest rates are now 5% in the UK. We haven't seen that for since before the financial crisis in 2008, and they're 5.25% in the US. They're forecast now to go to 5.75 probably in the US, and over 6%, indeed 6.5% in the UK. And it was Walter Bagehot, the great Victorian economist and journalist, who wrote that John Bull can't stand 2%. Or 2% after when interest rates in the UK went below 2%, John Bull didn't like it and used to do all sorts of stupid things in terms of speculation with his cash. Now, to use the analogy another way, I don't think John Bull's going to stand 5 or 6% interest rates, because it's really going to end up breaking the economy. But the problem we have, to go back to it, is that governments are still stimulating the economy through big fiscal deficits. And if you think in the UK, government accounts for nearly 50% of economic activity with all of its spending, and government spending is increasing year on year by quite a bit, then that gives you one pretty inefficient stimulus, because people spend their own money better than government spend it. But secondly, it ends up with government becoming a big part of the economy, and rates having to go higher and higher because the market demands a higher price for these big fiscal deficits. And it's not really that clear that when the economy is going to return to a balanced budget. And I think this is the big problem now, in that the governments and government bond markets are going to crowd out all economic activity and frankly, risk crowding out all other investments. So I think we're now waiting for the recession. I think the recession is, as we've said all along, almost certain, but the uncertainty is just when it happens. We started the year running 190% gross exposure. Because interest rates keep going up, we think that the cost of taking leverage in the fund is prohibitive. So that's been coming down all year and is now just 100%, which is the lowest that it's been in many, many years. We're expecting to make very good returns on our short book for the rest of the year, and we're very cautious on our long book. So, I think we've outlined reasons to be interested in investing in the fund over the long term, which comes from the value of an uncorrelated return. And please watch our video on the investment free lunch, our recently published documentary, which I think explains that very well. But I think also tactically, sensible investors should be taking money out of risk assets, holding cash, getting a good return, and also looking at this fund as a very good way to get uncorrelated returns and a fund that has proven itself in more difficult markets.